Hello everyone, it's Professor Reiko here, and today what I'm going to walk through is a video that captures the sale of an investment in bonds. And what I'm going to do is I'm going to do the sale as a held to maturity, then as trading, then as available for sale. Because in some of the prior videos I talked about what the Kiso book does and what the Spiceland book does. And so what this one is actually walks through the Spiceland book and shows how each one is treated when we sell them. Okay, so this one's good because it kind of keeps it allows for you to see them all right in one video together, and I think this will be helpful going forward. Okay, so let's see what we got here. We got a company that owns some bonds. Amortized cost. Remember, amortized cost is the value in the amortization table, the far right-hand column. All right, the fair value is 502. The amortized cost is that 473 number. And it says if classified as available for sale or trading. I'm also going to do held to maturity just to have all three of them as in one video together. Uh, but if they were the available for sale or trading, we're going to assume that we have already recorded the fair value adjustment of 29,484. Okay, so if you notice 29, this number right here is the difference between the amortized cost of 473 and the 502,749. Okay, so what we're saying is that's already been recorded. Now remember, the reason why it says if it's available for sale or trading and not held to maturity, because remember, held to maturity, we do not update them for available. I'm sorry, we do not update held to maturity for the do a fair value adjustment for those. So a couple days later, on January 2nd, 20, we're going to sell the bonds for 510. So we're not going to worry about updating amortized costs because it's only been basically 2 days. So we're not worried about that. And so the fair market value has changed. Okay. Face value of the bonds is 500,000. All right. So let's kind of get going here. All right. So we'll start with held to maturity. And remember, with held to maturity, there's only one journal entry when you sell it. When we get to trading, there will be two. When we get to available for sale, there'll be three. All right. So remember, if you struggle with journal entries, just kind of think about what's going on here. All right. Well, I'm selling something. All right. So I'm getting cash for that. And if you look up here, you can see the amortized cost right here, the 473. Remember, that's less than the face value of 500,000 of the bonds. So that means these bonds were originally issued at a discount, which would have been a credit balance. Since we're taking it off the books now. So remember, if you sell a bond or an investment in debt, investment in bonds, you've got to take that discount off the books as well. So look, what I'm doing here is I'm just putting down accounts, and I'm not even worried about numbers yet. All right, skip a space here for our gain or loss. And then we're going to have investment in bonds. Some books call it investment in debt securities, but investment in bonds and investment in debt is the same thing. All right, and that also has to come off the books. So we can kind of start filling a few things in here. All right, so remember, cash is just what we sold it for, and it tells us we're selling the bonds for 510,000. We also have a discount on bonds payable a discount on the bond investment has to come off, and that is 26,735. And remember, if we had an amortization table, it would be that unamortized discount column in that. But we don't have that. But remember what that number is. It's the difference between the face value of the bonds and the amortized cost. All right, so that's where that number comes from. All right, the investment in bonds is still 500,000. Remember, our very first journal entry, we put it on. At cost is the very last entry, we take it off. All right, and then now you can see here we're left with 36,735. Okay, so that we can see that it's a credit, so it means it's going to be a gain. But remember, another way to calculate that is to take the difference between the sales price 510 and the amortized cost 473,265, and that would also give you the 36,735. Okay. All right, so that's held to maturity. If you look back in one of the earlier videos, we did something similar to that. All right, so I'm gonna draw a line here, and now we're gonna do trading securities. All right, now with trading securities, there's two entries. All right, because we're keeping up with the fair value adjustment account dealing with trading securities, if we ever sell it, we have to update that to the point in time where we are. All right, so remember, we had just recorded that, all right, on 12/31/19, but now the fair market value has gone from 502,749 up to 510. That's what we're selling for, so that's the fair market value. So what I'm going to do here is I'm going to put this, so what we need to do is we need to say, all right, well, we've got amortized cost, and that's 473,265. We've got the fair market value, and that is 510,000. And then we have the difference, let's call that the unrealized gain or loss, and that's a difference of 36,735. So remember, we've already recorded an adjustment. So the beginning balance over here in our fair value adjustment T account is at 29,484. All right, how did I know that was a debit balance? Okay, let's think about that for a second. If you look up here, the fair market value, when we did that, 502,749 is greater than the amortized cost. So that's a good thing. So that's a debit to the fair value adjustment account, which is a companion account with the investment account. All right, now what we're saying is, remember, we're now saying the ending balance needs to be 36,735 because it's gone up even more. So how do we get there? Well, we need to increase it by 72.51. All right, so I'm going to put, we're going to have a journal entry to update, so we're going to update our fair value adjustment. So we're going to debit fair value adjustment for the 72.51. All right, and so that is that debit right there. And then we're going to credit gain on investment, unrealized, and remember, this is trading securities, so they flow through net income. All right, so that goes through net income, which means we're already recording the gains and losses in income. All right, that's an important thing to keep in mind here in this next journal entry. All right, so now we can sell it. So we updated the fair value adjustment account. All right, so now we need to sell it. All right, so now look, in all three of these, we're going to get cash of 510. We're going to take the discount. I'm going to leave off on bond investment just to speed things up. 26,735. Skip a space here, and then the investment in bonds is going to come off for 500,000. That is the same every single time. Okay, so now look, we know this number has to be 36,735. Now up here in the held to maturity, so I'm just going to draw the line right there. We recorded it as a gain, and it was a gain because it had gone up in value. But remember, we're trading securities. We are already recording the gains as we go into net income. Okay, so if we were to put a gain down here in the sale journal entry, we would be double counting that gain because we counted it once. We update it here, 72.51. All right, and so that unrealized has already been recorded for 36,735 over the life of the bond. Okay, so that gain is already included. So what does this credit need to be? Okay, so if you're looking at this, what is still open related to these bonds? All right, well, it's the fair value adjustment. So look up here. If I credit that account for 735, it zeroes that out. And I need to zero that out because it needs to come off the books because it's associated with this investment that we're selling. All right, so that comes off the book. So be careful there, not a gain. Notice everything else is the same, except it's a gain for held to maturity, and it's a fair value adjustment here. Why is it a fair value adjustment here? Because we've already been recording it in net income as we go. All right. Now, lastly, we have available for sale. Now, remember, available for sale also uses a fair value adjustment, but it goes through other comprehensive income. All right, so this one's a little bit different. This one actually has three journal entries. All right, so for available for sale, so I'm going to just write this. We still have to update. All right, so we still update. That should be 1L. We still update it, meaning I'm not going to rewrite this, but I'm doing this work right here over again. Okay, so I'm doing that work over again, which means I still need to do this journal entry to update it, and all these numbers over here are going to be the same. Okay, so I'm not going to rewrite it just for the sake of time, but just know where those numbers come from. I've been doing the exact same thing. All right, so my journal entry to update would still be fair value adjustment for the 72.51 to update that account, and then we would have gain on investment, unrealized. And remember, this goes through other comprehensive income. Now, remember, other comprehensive income flows through to accumulated other comprehensive income, which is in the equity section of our balance sheet. Notice we haven't recorded anything on the income statement. All right, but now we have an actual sale going on. All right, so we want to now get it into the equity section. We want to get it into the income statement. All right, so what we do now is I'm just going to write out, we're going to reverse prior fair value adjustment out. Okay, and what this also is going to do is going to get it out of other comprehensive income. Because remember, we've been accumulating this into other comprehensive income as we go. All right, so we've been accumulating that. So if you think about the fair value adjustment T account over here, we had I'm just recopying it from the previous page, 29,484. We just did the 7251, which is that, which gave us 36,735. All right. So the difference here is we have not been recording it in net income. We've been recording it in comprehensive income. All right. So what we do here, they call this reclassification. I'm going to abbreviate reclassification adjustment dash OCI. So notice, remember this account right here, and then the mirror image of that would be a credit in the OCI total that would have been accumulating for 36,735. So if I do this right here, 36,735, it reduces other comprehensive income. It kind of backs it out of it, that account. Okay, so that would now be zero. I'm not going to write all that out, but the offside of that is the fair value adjustment, 36,735. Now look, this closes this account out. So that's now closed out, so we don't have to worry about that anymore. All right, we've taken things out. We've zeroed out. So this right here basically is zeroed out what had been put into other comprehensive income. All right. So why do we have to do that? Well, now we're recording the actual sale of it. All right. So now we're actually going to sell it. Now remember, when we sell it, we are actually going to have a realized gain or loss. You know, we know it's a gain in this one. So remember, we're still selling it for $510,000. That has not changed. We still have to take the discount on bond investment off the books. And once again, I'm just abbreviating to speed this up a little bit. We still have the investment in bonds coming off the books at $500,000. All right. Now look, here we've always been recording it in other comprehensive income. We have not recorded anything on the income statement. So now we actually have to record the realized gain. All right, for the 36,735. Okay, so this gain, so let's think about this. This gain goes into our income statement, all right, which increases income. All right, remember, income statement gets closed out to retained earnings, and retained earnings ends up on the equity section. So what we did here, this right here, you can see where I'm scribbling, reduced equity, because it would have flown through to other, accumulated other comprehensive income. So this reduces equity, and then this essentially increases it by the same amount. And this is all happening at the same time. Okay, so we're essentially getting it out of other comprehensive income and putting it into retained earnings because it's now a realized gain. All right, if you notice, this is the same as held to maturity, right? So I like doing this problem like this because they're all together. So I kind of squeeze this one in afterwards. That's why it's called Investments 4.1, because it kind of I did all the other videos, and this kind of needs to be with the investment in bonds section or investment in debt security section of the note. So I wanted to get it to where it would squeeze in at the correct place in the kind of the flow of the lecture video. All right, but this is a really good one to use because I think for me, if I'm studying this chapter, I think probably the sale of investment and debt securities is the hardest part because we have 3 different classifications we're dealing with, and they're all handled a little bit differently, right? So use this as a tool when you're studying to really kind of get a grip on why we're doing each different thing in these journal entries. Okay, so hopefully I explained it well enough, and if you go back and watch it again, hopefully it will make a little bit more sense and help you to kind of figure things out moving forward, especially come test time. Okay, hope you enjoyed that. Hope that helped clear some things up, and I will see you guys next time.